All right, today I am joined by Emmet Peppers again for episode 227. Welcome, Emmet.
Hey Dave, nice to see you again.
Hey,
Yeah.
happy New Year.
Happy New Year, 2021. We're kicking off with a bang, hopefully.
Yeah,
Yeah.
it's been a crazy past year, and yeah, I wanted to chat with you about this year. I've got a ton of topics I wanted to kind of discuss with you. And first, though, I wanted to actually first we need to do a disclaimer. All of this stuff is just personal opinion, conjecture. It's not investing advice or telling people what to do or how to think per se. And we'll add a disclaimer also in the video description. So that said, I wanted to talk about a whole host of kind of different topics with you. And I think the general theme though is how do we find opportunity in the year 2021? Kind of what's
hmm
kind of the overall strategy? What are some areas we're looking at? What are some sources that we're kind of connected with? And I wanted to kind of make that the bigger theme. But first off, I wanted to go back into your options trade because I don't think we've completely heard a final update. So a bunch of people
No?
are curious. I asked people on Twitter some questions, what they wanted to hear from this discussion. And all in Tesla said he wants to know an update on how you managed and are managing your 700 strike January 15th call option trade. Victor Co. MD says, what are your current Tesla option positions? And do you plan on initiating any new ones soon? So yeah, what's happening with your option? I think last time you had half of your 700 strike January 15th
Yeah.
still on, and then you took on a position of a 900 strike, right? January 15th or so, was it?
Yeah. Yeah.
A
Yeah.
smaller position just in your IRA.
Much
So what's,
smaller, just an
yeah,
IRA. Yeah.
yeah. So what's going on with those trades?
Yeah. So the big trade, I closed out half of it in December. I forget what day exactly, but I think it was around $42 or something like that, a contract when I closed out of it, and Tesla was trading around 650 at the time or something like that, or 640 maybe. Um, and I was just nervous going into that weekend that the market was going to kind of roll over and tank on that Friday. So I closed out Friday morning, felt like cutting half my position for a 6x gain would guarantee me, even if the other half, went worthless, it would still be a nice return either way. Tails I win, heads I win in that type of situation with the trade when I look back on it. So I kept the other half position on, thinking I'm going to hold it and ride it for a lot longer now, less risk for me, and like in my mind, less nerves, because I already kind of guaranteed myself a 3x return on the overall trade. So this other half of the position still on. And we just had a nice Morgan Stanley upgrade today, which was a nice, pleasant surprise. But I just picked that January 15th because I felt after the S&P inclusion in the following weeks, there'd be benchmark managers, laggards, catching up, getting some FOMO to get on board with Tesla, pressure from maybe their shareholder, their own funds, investors, and so forth. And I just thought it would be kind of like a nice potential for a rise after the S&P inclusion, and hopefully that's sort of what's happening here. And yeah, so I have the other half on right now. I think at the close today, before the Morgan Stanley upgrade, they closed around $45. So they're still around $48 a contract, I think. $45 a contract. So they're still about the same price as what I closed the first half at, which is kind of interesting. Um, it's kind of hovered around that a lot, it seems like. But I'm holding on to it, and it could go up significantly more to 800 in a week, or it could go back down to 700 and become worthless, right? It's kind of like a 50-50 coin toss, you could
Mm-hmm.
almost say. But I think it's more likely to go up. Otherwise, I'd close it, right? So that's sort of what I'm committing to try to stay into it longer and see how far I could take it.
Mm-hmm. What about
Maybe
your
till expiration.
900 strike calls that you had?
Yeah, that was a little aggressive. I thought that that S&P inclusion day, that triple or quadruple witching day, when there was all that craziness going on, I thought there could be a chance of like a major squeeze towards the close, and there was a closing price print of like 695, and even though it was trading at 650 or something like it was kind of weird. There was some weird stuff going on. So I bought those for like I think it was like $5 or $6 a contract in my IRA. But that was that was probably 1/10 of the size of the, or maybe like 1/5 of the size of the other contracts I bought or I put on. And so I still have those contracts. They're worth about half as much as they were when I bought them. So those might very well go down to be worthless. But if the stock rises to 800 or so in the next week, I would imagine I could probably sell those for even money, and I might just do that to get out of it because the price hasn't risen as quickly as I thought it could when I put that trade on, right after that. So
Yeah.
that's sort of my plan.
Yeah, I think a lot of people were shocked. I was shocked by the 900 strike.
Yeah.
uh,
I just
it's
thought there was
like,
a small chance, like a 10 or 20% chance the stock could just go nuts for like a few days after that. Yeah.
yeah. Um, it's interesting because I think the general idea or sentiment from most people was that on the S&P 500 inclusion date that it could spike, but then lots of people were expecting a pullback. I
Mhm.
think on Twitter, like Gary Black was expecting a 10 to 15% pullback or something in the coming weeks or a couple weeks after, within the couple weeks after. But for you, you kept the trade on. What was it? The whole benchmarked kind of funds would continue to buy. Was that the main thesis of why you kind of kept the trade on?
Yeah, I mean, it's a humongous pool of money. And then there's all these closet indexers out there, which are like, money managers or asset managers that technically are not benchmarked, in their prospectus or whatever to that for their fees to to the S&P 500, but they're really just copying the S&P 500 for the most part and trying to mimic the performance, and they're charging, much higher fees than someone could get by buying the ETF and SPY or whatever. So there's a ton of closet indexers out there too. And so I think that combination is just much bigger than people realize. And it could spell like a nice rally for a few months in Tesla. It's hard to say how long the rally could last if that huge tide of benchmark funds all come on board eventually. I feel like there were some periods of time in Apple where like a bunch of benchmark funds kind of started going overweight Apple all at once. And that was years ago, but it just seems like we're at a huge transition point potentially where more and more of these portfolio managers are realizing they better get on the bandwagon before they get left behind.
Yeah. Um, yeah, it's interesting because this past week, Tesla's been doing pretty well. And then aftermarket today, so this is recorded, on Tuesday night.
Yeah.
So Adam Jonas from Morgan Stanley came up with the upgrade. I think he upgraded it from $540 price target to $810 price target. So I'm thinking like if the stock price continues to go higher, it seems like that motivates benchmark funds to get in more because then you've got this tracking error, right? You've got this discrepancy with the funds that the S&P 500 that they're benchmarked with, right? And so it seems like if Tesla would have gone down and stayed down, then they could just take their time. But if Tesla's increasing, then it's like a big tracking error, so it actually motivates the funds to get in. Is that kind of how you're seeing things?
Absolutely. Yeah. I mean, I think these benchmark funds, the portfolio managers, this is their livelihoods, this is their jobs, their personal incentives. Whether they personally believe Tesla or not as a company, their personal livelihood, their bonuses, their stability of their job, sort of depends on staying in track with the S&P 500 and not falling behind, right? So there's a lot of pressure on them, even if they personally disagree and think it's overvalued. They really just have to kind of get on board pretty soon, and the more momentum Tesla gets, the harder it is for them to stay off of it. And so I think a lot of people that were anticipating the rise of the S&P 500 inclusion, and not only the front running arbitrage folks selling to the index funds, but all of the institutional owners that have owned Tesla for a long time that were looking to lighten up some of their position in Tesla. I think a lot of them have already done that. And so I think the amount of sellers is going to be less and less as well, potentially. So that's my bullish thought process, and a lot of it depends on the macro market to stay kind of where it is, the climate of it, as well. Interest rates obviously are going to stay low, but just in general, overall market has been, pretty stable and rising steadily. So if that continues, I can see a nice extra rise going soon.
Um, I'm curious that because if you look at the past year of Tesla, I mean, we're talking about over 10x, right, just within a year. I mean, that doesn't happen very often, especially with a big cap
No.
company. And so when you look at kind of Tesla going into 2021 and specifically the stock price, like how can you, in a sense, like are you remaining bullish? And if you are, do you see kind of like more a moderate appreciation, or do you see volatility still this next year? Like what are your thoughts going into 2021? Because I know going into 2020, we
Yeah.
both were very kind of bullish. Like we could
Yeah.
see the momentum, just the many years,
Yeah.
right, of
Yeah.
consolidation, and we could see a breakout coming. But in 2020, going into 2021, it's completely different, right? The breakout has happened, but
Yeah.
it's been bigger than anyone had expected. So, what are your
Yeah.
thoughts?
Yeah, like you said, I remember going into 2020, you and I would talk about it and text about it and think we were kind of like expecting the price to go up 3 or 4x at least, maybe more potentially, and so we were kind of not as surprised as a lot of people. But I think you and I both are on a similar page where we don't think it's going to 10x again. And this year, that was, the chance of that's not going to happen again. Could it 2x? Possibly. 3x? That's a stretch, so that's what I think. I think it's going to be less volatile. I mean, I think it could certainly get cut in half at any time, especially if the macro market, is correcting. But now that it's tied to the S&P 500, it adds more stability. So the beta, is not going to be as significant as it used to be. And so, if the overall market is tanking 5 or 10%, like in the COVID crash, in a day, Tesla could drop 20% or 30% on that day. And I think now in such a crash, maybe the overall market corrects 5%. Maybe Tesla goes down 7, 8, 10% at the most, but it's not going to go down 20%. That's just my opinion. I could be wrong, but I think that now that it's tied to both the Nasdaq and S&P 500, it's got a lot more a lot less volatility inside of it. I mean, what do you think? Do you think that's the same, or what do you think?
Yeah, I definitely agree. I think the shift to S&P 500, you've got all the index funds, you got the benchmark funds, you got a significant, not just buyers, but you've got the mentality, you've got the paradigm has shifted with Tesla. So it's no longer kind of this super crazy volatile stock per se. It's now part of kind of more of these like, you know, large cap growth stocks, right? Along with the fangs and et cetera. So I think that's definitely the, part of it. I agree. I think a lot of it depends on the macro environment. I mean, it's like, I think if the market continues to weigh these growth stocks very optimistically, and let's say the Fed continues with their quantitative easing, and low interest rates are just super low, or even if all of these factors combined, I mean, I could see Tesla doing decently okay this year. I personally, I just have very low expectations in general, because first off, I don't have like any leaps or option calls on Tesla at this moment, and I don't
Yeah,
need it to go up at all. And I'm happy with its price. I'm happy if Tesla consolidates for a couple of years too. It's
yeah,
like it's totally normal for that to happen. I was happy when Tesla was at 400. It's like, um, so. Anyways,
yeah.
yeah, I think yeah, I don't know. It's hard to tell. I mean, but I'm looking at the macro environment a lot more, I think, nowadays to give me some indications about things going forward. Yeah.
Yeah, absolutely. It's just you just don't know. Like, I don't know. There's like rumors of this new strain of the coronavirus in South Africa, not, the immunity from the previous one, and the, not being effective for the new strain, new mutation. If something like that turns out to be true and it's more contagious and it goes, exponent, and it's like round two, but worse, that could really spook the market, and cause another crash, for example. But, that's the type of thing I kind of look for and try to keep a close eye on to get an early beat on in case something like that could happen.
Mm.
There's lots of black swan events that could happen too. I mean, that's sort of a white swan. We're all kind of know about that potential scenario. The coronavirus itself is sort of a white swan in that we knew a pandemic was going to come, but we just aren't prepared for this type of stuff very well.
Mm-hmm.
So, and there's any number of black swans that could happen that could really create a major bump in the market, and and so forth.
Yeah.
Yeah.
Yeah, I definitely am expecting, a bumpy ride. There's always a bumpy ride,
Yeah.
especially when things are so optimistic, for such a long time. So we'll see.
Yeah.
I'm curious, for 2021, how do you think about finding opportunities like this year, both short term and long term? I'm guessing most of your holdings are still long term with Tesla stock and
Mm.
long dated options. But in terms of maybe your kind of betting on perhaps a possible super move in different ways, how are you trying to find those things,
Yeah.
those moves, those opportunities? Has your mentality changed at all from last year? Like, actually, I want to go actually a little bit deeper on this because I want to
Okay.
actually kind of dive into a couple layers deeper.
Okay.
You had a great year, as many Tesla investors had, but you've had a kind of a little exponentially greater year with your options bets. Um, how do you not compare this 2021 with 2020? How does
Yeah.
2020 not become like an obstacle, like
Yeah.
a mental block? Do you lose motivation at all? Do you just like want to just relax a bit, not be
Yeah.
so just into, having to find opportunities? Like, or is there something that's compelling you to say, I've got to, find more opportunities? Like, what's going on behind the scenes?
I'm not even gonna get a 10x return in a year. That's like ridiculous in itself. And I would be happy with a 2x return, to be honest. That's kind of the benchmark I set for myself. Like if I could double, the assets in my fund through investing, or that would be awesome. I don't even know if that's gonna happen. Like, so, but I am curious. I try to remain curious and look for new opportunities, not just Tesla. Like Tesla is my highest conviction name, but at the same time, I'm trying to branch out into other ideas more. I'm trying to just keep my mindset of being opportunistic and curious at the same time, and not be afraid to take risk. I pulled my, I don't want to go into details of the trades and my fund any, so much. But I pulled my first trade in a new stock. You and I haven't even talked about this stock ever before. You probably, I'm curious. I'll talk to you privately later and see what you think of that, maybe. But yesterday in a new stock, and it was nerve wracking. I was like, wow, I'm entering a new realm of a new stock that I haven't ever entered, and it was in a significant. It was like 8% of the fund or something,
Mm-hmm.
and so. Um, it's just fun. It's fun. I think of it as compelling intellectually for me to kind of take risks and hopefully be good. I'm optimistic now that I can be good at it. If I place a lot of bad bets in a row, that could change my attitude. But I'm kind of coming out of the gate, running this year, and I know I'm not going to match the record of 2020 I had, but I'm just hoping to put up a good performance, and I think I'm confident. I have the confidence now that I didn't have before necessarily, but overconfidence can be a bad thing too. So
Mm-hmm.
I'm diversifying more in a way that I'm, trying to focus on maybe 10 names as opposed to two or three name or one name or two or three. And it might turn out that even if I diversify and do pretty well, maybe it'll turn out that if I just stayed all in on Tesla, I would have done better in the fund. We'll see how that plays out. In my personal accounts, I'm still it's the vast majority is still Tesla. I'm just not ready to take tax consequences in my personal accounts, and I still am very highly convicted, and that's the majority of my wealth actually. But I just more actively am trading the fund and playing with my investment philosophy in the fund, so to
Mm-hmm.
speak.
With motivation, how much of the motivation that you find personally to, let's say, find opportunities to grow your fund, etc., your accounts, how much of that motivation is what I'll call positive motivation, meaning something that you want to gain, let's say, accumulate gain, whatever. I don't know what that exactly is, versus how much of it is avoiding negative kind of consequences, right?
Mm-hmm.
What do you, like? I don't know. What's your breakdown in terms of what really kind of motivates you, to get up and go after opportunities?
Much more positive. I would say I'm much more optimistic that I can, have a good performance, and that's easy to do when the markets are going up and in your favor and you're performing well. It's easy to flip back to the fear of, you know, losing your assets and investments when the market turns against you and close out your positions at a loss, for example. So I keep that in mind, and I know that as we've been through this ups and downs with Tesla so many years, you just know that when you have conviction, you have to find enough conviction on a name that you want to hold it through ups and downs, right? And so when you buy a name, you know that there's going to be downs, and you don't know the timing of your buy, if it's going to be right before a down even. So you just have to kind of expect that there's going to be some downs, and when those happen, they're expected. And if something that really, I try to pay attention to my investment thesis. Similar to, I think you talked about in your podcast the other day about the separating the stock from the company, and I try to focus my investment thesis as much as possible on the company, more than the stock. Minus this S&P 500 inclusion trade that I did for Tesla, which was basically, an investment thesis on how I thought the stock would behave from that event. Not, it had nothing to do with the company. The company's great, great fundamentals. I just thought the stock would behave a certain way based on that event. But most of the investments I do are based on what I think about the company in the future, and looking for 2021 beyond. I think what we were talking about before, like, I just try to envision the future, right? Isn't that what you try to do? You try to figure out what the future is and work backwards from that, right? And so we're constantly changing what we think the future is going to hold based on the information new information we're getting, and then you kind of work backwards and think about how to take advantage of that with investing.
Yeah. Like one thing that you said a while, like at the beginning of your S&P 500 trade, you said it to me personally, but then also I think in our interview, you said that you would be, in your view, that it would be irresponsible not to put like 5 to 10%, right, into a trade like this, just because you saw it as such an obvious catalyst, right?
Mm-hmm.
When you say that, like, how much of that is, what does that mean? Like, that you would be irresponsible? Does it mean that, are you looking at it in terms of like what, who cares if you're irresponsible? Like, I mean, what is that, like, what's the motivation behind that, to frame that? Like,
Yeah,
most people would
yeah,
say,
yeah,
oh, I should make this option bet because I could do a 10x or whatever. But for you,
yeah.
it's a little bit, that was a little bit of avoiding a negative in a sense, right? Avoiding being irresponsible, right? So does that come into play at all in terms of your motivation, like on an ongoing basis?
Yeah, that was really unique because we've been studying it so long. Like, I don't know if I'll ever have as much knowledge about one stock as I have with Tesla, and Tesla's such a good case because there's so many niches within Tesla. I'm not an expert on any one, like, I am enough of an expert to know the stock overall better than 99% of the people who follow it, and you too, especially, but I think we both would agree that there's people out there that understand the neural network better than we do, and there's people out there who understand the delivery numbers specifics better than we do, and the supply chain better, but overall, as a company in the stock, I think you and I and a select few are in the top 0.1% or 1% of people who understand it, right? Um, and just knowing that I knew that about me, and when that event happened, the S&P announcement, and I just, something clicked in me and said, like, Emmett, if you don't do something significant with this trade opportunity, you're going to really kick yourself in the future, knowing you should have done it. Like, I didn't necessarily like really want to do it. I was like already doing so well this year, but then that happened, and I was like, kind of hoping the S&P inclusion would happen after I took on the first investors in my fund, because I was like kind of happy, like, hey, they're not going to do it till next year, and I'll have some investors in the fund by then that I can give some fruits to with this trade that I'm planning. And then it happened, and I was like, I just have to do it. Like, I would be so mad at myself if I didn't try it, and especially if it worked out the way I thought it did and has to some degree, So that's sort of where that line, that voice told me, like, it's irresponsible of me not to do this trade, with significance. out of my portfolio, I guess. But it was like I was avoiding regret, put it
Got it.
that way.
Yeah, yeah, yeah. So it is, in a sense, that was avoiding a negative and avoiding personal negative, avoiding a personal like future regret in a sense,
Yeah,
because you could have
yeah,
just stuck with your leaps in your stock, right?
yeah, yeah,
Controlling over 100,000
yeah,
shares with S&P 500 inclusion, you're looking at a huge bump anyways, right? That's the most like safest, road. But to put
yeah.
a
And I didn't
good
have
amount,
extra
yeah.
cash. Yeah, I didn't have
Mhm.
extra cash. Like I had promised myself not to use margin again, and I had just like gotten to a point where I wasn't using margin, and so I actually borrowed on margin to put a lot of that trade on as well, which is
Wow.
like violating my own personal rule, But
Yeah.
so it was like I don't plan to use margin again, but in my personal account, I
Uh-huh.
did it at that time.
Uh-huh. Um, at the end of 2020, did your accounts hit nine figures
I
or
think
close to?
they're close to that
Close to.
now. If you count the SpaceX investment,
Okay, yeah,
the house we bought, and my Bitcoin holding, all that. If you add all those
yeah. Mm-hmm.
little, those remainder, it's close. Yeah, it's
Yeah.
close to all in. But that's also before taxes.
Yeah, that's true.
It all gets
Yeah.
cut in half. Living in California, especially. Yeah.
Yeah. Yeah. Taxes. Um, so I want to ask you a few more questions. So we have a OBYHUN from Tesla from Twitter says, "What are your info sources like articles, daily news, Twitter accounts, etc. that you follow, um, and what are popular info sources that you consider useless or harmful?"
Mm.
Yeah, so
I
both
think the latter
positive
is
and
more
negative.
important.
Uh-huh,
It's
yeah,
funny, that's a good question. I think the latter is more important. You want to identify almost the sources to avoid and to not and to not take seriously or not even bother with, and a
mm-hmm.
lot of those times it's like mainstream media stuff like CNBC or New York Times. Once in a while there's a couple, like when I look through, we can have another chat about the speed reading. I read, your speed reading thing, and
Yeah,
there's some really good stuff in there. But one of my tactics is when I kind of skim articles, and my tactic is I just look for the quotes, because a lot of times, like these long drawn out Wall Street Journal articles or whatever, it's really just the quotes that are the important thing. Whoever they're quoting, what the quote is saying. Nothing that the editor and some of the journalists are informed and so forth, but they're not informed like me and you and most people who follow Tesla on Twitter even. And so you just go through those articles and look for the quotes most of the time. Um, but I also like to go right to the source. Like whenever, like I know you're a big fan of looking at every possible interview and with Elon Musk directly, for example, and founders and so forth. And I think going right to the source of the decision maker of the company is the best. You cut out all the noise that way, or as much of the noise as possible. It's only the fluff that person is telling you that you can cut through, but not the fluff on top of other people's fluff on top of other people's fluff that you can't see through, right? So I think direct interviews is important, and also then you pick out a few key investors or traders that you really respect and think has good judgment, and you listen to what they say, seriously. But you don't believe everyone. You always try to be skeptical of what everyone says and almost try to prove everyone wrong. And if you can't prove someone wrong very often, then maybe that's someone to listen to.
mm-hmm. Yeah,
I don't know. That's what do you think?
yeah. I kind of, yeah. I also have like this maybe a little bit of an atypical view. Um, I'm not very like um, impressed by financial media or by so-called stock pickers or stock services or all this stuff. I feel like in a lot of ways like people are just regurgitating everyone else's like picks and it's very just like herd mimetic, like everyone's following each other, not wanting to miss out. I like to one of the things I like to do is I like to keep up to date with like what really kind of smart people in tech, especially like programmers, developers, like not just famous people, but just people on the ground. Like I follow this one site called Hacker News. It's called news.ycombinator.com, and
Okay.
it's I've been following this for like 15 years or something crazy from very early on, since when it got started, and it has like some of the smartest developers and programmers out there, and they post like a Reddit style. This is actually Reddit copied this site, and by permission,
Okay.
because this site Y Combinator was it's like an incubator. It produced kind of Dropbox and Airbnb and like hundreds and hundreds of other startups from this incubator. But a lot of the smartest kind of developers frequent this site. They post articles, they comment. And this is kind of where I kind of got connected with Elon Musk and Tesla, because I started to see their perspective on Tesla early on in like 2011,
Hmm.
2012 or so. But I try to find out what these developers are fascinated about, like what they're really intrigued by, and
Hmm.
what they think the future is, and
Hmm.
and I try to get into that mindset and try to learn and understand what's going on, and that's kind of like one example of a source that I'll use. It's not investors. I feel like investors, they tend to generally not be deep enough. They kind of are in it
Hmm.
just for the flip, right? For the gain, and they're out of it. They're
Yeah.
not really true, like, fans of whatever it
Yeah.
is. Like, I feel like sometimes when you get to more of a true fan, like a true developer, right, who really understands like technology, where it's going, they're going to understand it not just for a financial gain, but they're understanding it for the love of the technology, right?
Hmm.
But
Hmm.
that's like one example is when we talked about Roblox the other video, and
Yeah.
yeah, that's one of the places where I noticed a lot of the developers were like, "Hey, this is actually an amazing company, amazing platform. It's not what people think of it. It's not just a simple game, but this is something that kids are growing up with, learning how to program, how to create kind of these eventual metaverses as well." And so it's
Yeah.
like it's it helps. It's helpful when I have a filter of kind of that's not from an investment kind of world, that's
Yeah.
outside of that, and so those are some of the signals that I kind of look for, and then I'll take those signals and then I'll do a deep dive myself, on the company. Like, I think it's underrated just listening to the founder, like on interviews. If people would
Hmm.
just, I think, spend their time listening to like as many interviews of the companies that they're interested in, right? Just of the founders that they're
Yeah.
interested in, like that would be like. I mean, I wouldn't say like you don't have to read the annual reports and all the filings and stuff, but if you have to just pick one thing, you know, um, like probably the founder interviews might be like the most valuable in my opinion. The problem
Yeah.
is most founders don't give enough interviews, and it's hard to really get in depth. So, but yeah, it's um, but I notice it's helpful to get some new ideas. Like, the other today, you sent me, I guess, the Motley Fool's 2021 picks, I guess top 10 picks, and you're like, hey, look what's in the top 10. Um, what type of services do you use? I mean, you're saying like actually you looked up to Motley Fool's, the founders
The
picks,
founders.
right?
Yeah.
And why do you
Yeah.
why what kind of like what has deserved that kind of appreciation of their picks?
I think their track record. I mean, Motley Fool is an interesting organization. It's a big organization of writers and all these people that have their own picks, and it's all falls under the umbrella of the Motley Fool, I think, to some degree. But the founders, in particular, the brothers Tom and David Gardner, they've had a very impressive history of picking stocks and sticking with them. Some winners, like Amazon, is one of their big winners, and I think Tesla, and they pick a lot of stocks, and not all of them are these generational companies, but amongst their picks are usually the generational companies in there. And so I just thought, like, they have a perspective that focuses on the founders too, just like you and me. They want companies that are founder led, I think, and that are changing or have incredible prospective futures ahead of them, and I think can outdo the competition or have some edge of some sort. And they have a track record. It's not just, so they're kind of originating their own picks. They're doing their own research. They're not kind of like, I know you said a lot of investment pickers are regurgitating what other people are telling them, what they're hearing elsewhere. I think whether it's ARK Investment or the Motley Fool founders, I think the thing that makes them special is they kind of do their own research and pick stocks independently based on what they think and not based on what the rest of the industry is picking. Like you go on CNBC and you have everyone saying, "Oh, buy Apple, because everyone else is saying buy Apple." It's like you don't listen to people on CNBC, that's for sure. Like that's like the number one thing. And so you got to find those independent thinkers that kind of have some kind of track record of success, I guess.
Mm-hmm. Yeah, I would
There's
love
another
to.
guy.
Good.
There's another guy I'm trying to get into, and this is on my list of things that I'm curious on that I need to dive deeper in, is like micro cap stocks. That's a very dangerous game, obviously. But there's a guy, I think Ian Cassell or something like that. I think I tweeted about him on once, an interesting financial guy to follow that I just started following. But he has a very good track record of picking micro. That's his specialty. But that's a whole nother realm to kind of potentially dive into that I haven't got into yet.
Yeah. I would love to interview David or Tom Gardner. I've seen their ads a lot,
Yeah.
but I have some questions because they're like, some of their ads are like, oh, this guy picked, Amazon and had a crazy whatever
Yeah.
return. But my question is like, okay, what percent of your portfolio did you put into Amazon, right? And did you keep over time? Like, there's like, I've seen ads like, oh, this person picked Tesla, right? In whatever, in 2012.
Yeah.
But my question is like, so what percent of your portfolio did you really put in Tesla? Did you
Yeah.
keep it, et cetera? Like, that's the other part of the story that, I think people, I don't know. I'd love to
Yeah.
hear more
I
about,
mean,
but
I think they diversify. I don't think their performance is, I think their performance outbeats the S&P 500 pretty hands down, but I don't think it's not like nothing like it's going to be a 10x in a year or 5x in a year, overall, because they diversify somewhat, but I think their diversification of picks is still beating the market significantly over many years of their like benchmark portfolio that they put forth. But they've just started some like wealth management businesses that I think have done pretty well and so forth. So up until a few years ago, they were only like newsletters. That's pretty much it, I think.
interesting. Red 54 something 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 on Twitter says, besides security options and Bitcoin, what are other investments that intrigue you? What do you think?
Besides Bitcoin, what was it? I'm sorry, question.
Security. So besides stocks, options,
Oh,
all this
stocks and
stuff.
options.
Like,
Yeah, I mean, I know we talk about real estate. I think that's stable. I don't think it's going to fight back. Something I want to look into more is income sharing agreements. Have you heard about income sharing agreements or anything? It's
no.
like I think it's similar to what that Lambda school is doing. Have you heard of Lambda school?
Yeah.
They basically give like people free education, but in a promise to give back a certain percentage of their earnings for X amount of years afterwards. So income sharing agreements, I think, is like a concept where like you pay off someone's student loan debt, but then they give you a percentage of their W-2 income for X amount of years after that,
Hmm.
And I think there's possible opportunities there in the future where people are going to group this together and pay off a bunch of people's student loan in a basket and say, okay, we're paying off all your student loan, but you pay us all 10% of your W-2 going forward for 10 years or something, or whatever it is, and 5% after that for 10 years. Yeah, I don't know what the arrangement would be, but then there'll be some outliers in there, like an Elon Musk or something in there, and you can make a huge amount just finding an outlier within the basket, So that's an interesting concept I've been thinking about. I don't know how to really get into that further, but I plan to research it more at some point.
Hmm.
I don't know. You have any other ideas other than stocks and securities and Bitcoin or crypto?
Yeah. So I've been in Austin for just like probably 3 or 4 days, and um, we're staying. We rented a house, but we're also shopping and talking to a bunch of agents. So what I like to do when I'm in a market, a real estate market, I'll interview a bunch of agents, and I'll interview like a lot of the top agents that I can find. And what's happening in Austin is like ridiculous. It's the craziest real estate market I've ever seen, like almost anywhere. And um, it's like everything almost is getting bid up. Like nothing's selling for like, asking price. Everything is getting bid up practically. And everything is just being like sold just within a few days with multiple offers. And there's just not enough supply on the market. And there's just all this demand. And I don't know where all this demand is coming from. I mean, partly it's all these companies coming in, partly it's all these investors probably, getting in, et cetera. But there's also like a shortage of housing because the city's kind of strict in terms of from what I've heard, in terms of allowing new construction and permits. And so there's all these factors where you have this huge demand and you have a small supply that's just, it's kind of like the whole Tesla thing in a bit, but in a different way. And it feels like things haven't even gotten started with the Tesla Gigafactory and a bunch of other stuff in Austin.
Yeah.
And
Yeah.
like back in the day, I would be tempted to like pick up a bunch of just like maybe single family houses or something. But for me, at this stage of where I'm at, it adds too much complexity to manage, a bunch of properties independently.
Yeah.
But yeah, I would be tempted to like driving around today. I was like, man, if like, it's tempting if I could be part uh, of building a new apartment from scratch or something, or somehow I don't have that experience though, in terms of building, from scratch. But I think that would be it would be a very interesting opportunity to build from scratch apartments, let's say in Austin or something. But yeah, I think there are certain times where you have these anomalies where you just have this crazy, supply and demand,
Yeah.
you know,
Mismatch.
yeah, mismatch, it's an imbalance, and it just creates a huge opportunity. And it's not all pretty because there are going to be people who are priced out of the market really quickly, investors flock into it. It's a messy thing. So I'm not going to say it's like all great for everyone, but yeah, there's definitely something going on, and I think it's part of it is this influx of people from other states and other places, and it could be happening with some other cities, but yeah, it's just it's quite shocking actually what I'm seeing here. Mind blowing. Yeah.
I wonder if there's any like exchange traded real estate investment trusts with a focus in like Austin or something. I remember back in the 2008 housing boom or 2007 or whatever, then there was a period where like these exchange traded real estate investment trusts were being created for certain regions, specific ones. So I
Hmm.
wonder if they're still around and if there's one for like, Austin
Hmm.
area, or maybe there's one for Texas. I don't know. It could be an interesting play.
Yeah, yeah. I mean, I'm not totally bullish on some areas. Like, for example, Houston is largely like energy and oil, and they're gonna go through a major transition, with renewables, etc. So I'm
Yeah.
questionable about certain areas. But but yeah, Austin, it just seems like it's
Austin.
caught in the
Yeah.
imagination of so many companies and people. Um,
Yeah.
yeah.
And Elon's planning to make the SpaceX headquarters there like pretty something really special, I think. I think he's trying to make it like a really major global attraction, to come visit, and like it'll be like
Mm.
all kinds of really neat stuff there. So I could see it becoming like a mega city over 10 or 20 years, and a spaceport for Earth, in a
Hmm.
way.
Yeah, yeah. Um, I want to talk about this. Lynn at HYL0212 on Twitter says both of your perspectives on potential inflation and how you will cope with this. So that's what she kind of wants to ask. So I noticed on your Twitter feed you replied to David Friedberg. So David Friedberg,
Hmm.
an investor, he said that if you don't think inflation is already here, you missed what happened to the stock market. Companies aren't performing better. We are just inflating everything. Financial assets first, everything else will follow. And he linked to the M1 money supply increasing by like $3 trillion this past year. And then you replied on Twitter saying it's more complicated than what you're describing. World and macroeconomics is much more complicated than we can understand. We all feel we have to have a story, narrative, explanation. It's human nature, but sometimes just surrendering to uncertain outcomes, expectations is the best option. Is the beat options best options.
The best
I
option.
best
Yeah.
option. I try to think of all the possible stories, narrative explanations I can and assign probabilities, but also realize there are possible scenarios I can't think of too and assign that some probability. So yeah, let's talk about this. So what's going on, you think, with inflation, with, let's say, stock prices, and with
Yeah.
various possibilities or scenarios here?
Yeah. I mean, I think the macro economy is just overly complex. Like anyone who kind of like pretends they know what's going on with it, with some, probability, if they think they know, not 100%, but they think they really, have strong belief or conviction that this is what's happening. I just call kind of BS on that because I think um, there's just too many variables to really know what's going on. There's always different countries, currency, interest rates all over. It's just, I think Jeff Bezos said it in one of his like investment letters once that the world is very complex, or in like for us to think we can control or predict it is silly, something like that, along those lines. And I remember when I read that, it hit home with me. He's one of those founders that you kind of knows has a lot of good insight and such. And I think inflation, um, this M1 money supply thing, you know, I I don't think I think good companies, real estate, that stuff could go up in value. I don't think eggs or milk are going to go up in value by the same proportions by any means. I think commodities don't go up in value that much. But I think people want to find places to store their extra wealth, their value, right? We all have extra wealth. We have increasing wealth, on average. Half the country or half the world, whatever the proportion is, the top 10% of the world or country is getting a significant increase in wealth over time, especially. And so we're looking for places to store that wealth. Gold doesn't do it for most people anymore. Like bonds have very low interest rates, right? And so what's next? Stocks of good companies. People are starting to flock towards Bitcoin as a digital gold, and real estate, like in Austin, like you're seeing, those types of things where people can store wealth will keep going up in value, I think. But everything else, I don't think will go significantly up in value. I don't know. That's sort of my take, but I don't know for sure. You know, it just seems like things are always inflating to some degree. You just don't know if it's going to be at 2% a year or 5% or 10%. And I think when you say the word inflation, it means everything to me. Like inflation, means everything's going up. But I don't think that's the case here in the U.S. At least. It's just the things that people store value in are going up because people have more value to store. I don't know. What's your thought?
Yeah, so I've been thinking about this a lot as well, and I think inflation, like when the people use the word inflation, I think it's an overgeneralized term. And when I think
Yeah.
of inflation, it's like I kind of separate it a little bit from like stocks and real estate in a sense because like I think certain things are supposed to appreciate in some certain ways, and some things are supposed to appreciate faster than, let's say, basic items. Like for example, a great company is going to appreciate faster, with its cash flows, etc. And so I think when people kind of group inflation and say inflation is just going crazy and it's going to cause X, Y, and Z, it's 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 I think a disservice, or it confuses the argument or confuses the point. And I think it's helpful to me separate inflation and to say, okay, you might have commodity of inflation or you might have consumer goods inflation, right? And then you might have asset inflation. But that's a little bit tricky because it can be convoluted a little bit with appreciation too. Um,
Yeah.
and so um, yeah, it's a little tricky to decipher that. But I think if you were to say, hey, the Fed's quantitative easing, money printing, et cetera, let's say printing $3 trillion dollars and growing, et cetera, this year or the past year, is is inflating assets. Like even that, I would say assets have gone up and it has inflated, but there's a certain percent of the appreciation that assets have seen the past year, certain percent that's due to perhaps money printing, and a certain percent that's due to some other factors. Let's say low interest rates, perhaps COVID. It's showing the resilience of certain growth stocks, different reasons to move to equities, and so there it's a mixed bag of exactly what's causing the appreciation. It's not 100% just the money printing is causing.
Yeah.
It's mixed. I'm not going to say that the Fed's printing isn't causing some of it. It's causing some of it. I don't know exactly what percent though. It could be a lot, but it's not 100%. There's a lot of other factors involved. And I think a lot of times people tend to oversimplify. They say, "Oh, I know why stocks are going up. It's because of this."
Let me tell everyone why.
Exactly.
A causes B, and it's much
Exactly.
more.
And you've got this other thing where consumer goods are in different ways. Some are going up, some are staying same or even decreasing. Like for example, you have this huge deflationary force with technology that's actually making certain goods cheap or remain cheap. So it's kind of this dichotomy. You have certain consumer goods are cheap, certain costs or expenses are growing. Let's say healthcare and education. I would actually think rent might go up because if you have asset appreciation with real estate, then that's going to maybe trickle down into rent prices as well. But it's a complicated scenario, and I think it's something that I'm going to be kind of interviewing some people on in the next month or two. Have you heard of the Chapman Index?
I think I've heard. To remind me what that is,
Yeah,
it
so
sounds familiar.
it's this index that someone created. Ed, I forget his last name, but he so-called tracks. I think it was like 150 or 500 or something of the most commonly purchased goods by normal people. But it's a little bit of a funky index because it's people that he knows. It's items that his people purchase often, which are it could be skewed to kind of a bit luxury items and stuff. But he
Yeah.
calculates it over the past several years or something as like 8 to 10% inflation. But there are a lot of critics of his index because it's such a hodgepodge, this thing of of random goods from his friends and people he knows, etc. But the question it poses is the inflation index that we use with the, let's say, consumer price index. People have a general sense that that's kind of rigged because the government wants to keep it down so that it can keep Social Security payments down, et cetera, all this stuff. So we know that maybe inflation isn't completely, at that point, and we see certain assets and other expenses increasing. So there seems to be kind of this frustration from a lot of people that inflation isn't being correctly assessed, right? And I think
Yeah.
that's where some of that, pushback with inflation as basically the Fed printing money has caused asset in so-called inflation is going to cause other inflations, and we're on this
Yeah.
inflation runaway train, right? And that's kind of the
Yeah.
narrative that's going on in a sense.
One of the interesting points about the people's complaint about the CPI and so forth, I think, is like, for example, cars. Like, oh, cars cost a lot more now than they did, more than 2% than on average increase over the last 10 or 20 years. It's more like a 5% increase or so. But also the technology in the car's quality, how fast it can go. If you want to buy a car that has the same specs and performance from brand new now that it had back in 2010, it's probably virtually the same price because of cost efficiencies in building it even. But just the fact that the products are getting substantially better to keep up with the demand, of that price level, because overall the wealth of Americans, of working Americans, is increasing. So when the wealth increases, people want to spend up a little bit on nicer things over time, and so the products are designed to be a little more nicer with better functionality or specs or whatever, and that they're going to inherently be a little more expensive too. So I think that's not fully captured by a lot of these people too.
Yeah. Yeah, it's there's some interesting things. I think it's definitely I think a topic that I'm wanting to look into more. I think it's kind of one of those like rabbit holes. I think as you
Yeah,
uncover more, you
it's
discover more stuff.
yeah, it's very complex. People like to boil it down to one word, completion, and one acronym, CPI, but it's much more complicated.
Yeah. I want to wrap up today's talk, and we had a bunch of questions. Actually, it's amazing on Twitter. We got like I forget, that's like 100 or 200 questions of people
Yeah,
wanting to ask. And
yeah,
here's a few
crazy.
questions about similar kind of advice for younger folks. Justin Cheng says, would you recommend younger people 18 to 19 years old with a reasonable amount of capital to invest in a stock market, or should they invest in themselves first? Gabriel says, what advice would he give to an 18-year-old Emmet Peppers? And
Yeah.
Attila on the World says, would you recommend, what would you recommend for young people? Is it worth to go to university anymore? What kind of businesses would you start now? I mean, you don't have
Mhm.
to per se address all of these specific questions, but in general, like, what are your thoughts in terms of maybe even
Yeah.
giving advice to a younger, Emmett Peppers, etc.
Yeah. I mean, I think one piece of advice is to open, a Robinhood account or whatever, with some amount of money, even if it's just a few $100s, just open that up and start, at night making yourself curious and using it and buying some stock. Experiment. Don't be afraid, you know, and just experience it. That's how you learn is experience, and you'll be more intrigued the more you experience investing, So the earlier you can start with some kind of investing, the better. I don't think you want to be 30 or 40 years old and doing finally opening up your IRA account then. You want to start doing that stuff as soon as you can at 18 years old or whatever, I think, to give yourself a head start because you're going to make lots of mistakes and it's better to make those mistakes early as opposed to when you're in your 30s and 40s. So I would say that for sure is the top thing. Definitely invest in yourself, always invest in yourself. And I would say university, man, I mean, I think it's overrated by a lot now. I think I learn a lot more in all the podcasts I've listened to in the last year than I probably did in 4 years at school. I think there's so much info out there on YouTube and podcasts. So for learning, universities I don't think are optimal, especially given how expensive they are. But for networking and if you want to just like have a little bit of a moratorium of like living life with networking and experiencing some kind of like social life with peers for a few years before you like embark on a career. I think going if you can afford it, it's not a bad idea, to do. But it's if you just want to kind of get started with your life, it's not necessary today. I don't think. Yeah.
I'm curious, what did you major in college?
I had three majors at first. I changed. So at first I majored in business in my first school, Boston University, and then when I got kind of kicked out of there, I went to Northeastern University and I changed it to philosophy because I liked all the deep thinking and so forth. But my priorities weren't straight still, and that's another thing I say to an 18-year-old Emmett is like get your priorities straight. Don't don't do too many dumb things. Don't you're not invincible. That kind of stuff. So. Um, but then philosophy was really interesting, but I'm just such a slow reader. I can't read those long word textbooks with long words like and complicated sentences. And so I had to switch it to my third chance. Luckily I had a third chance. Most people don't get one. So I ended up after living at home for a little while, going back to school and changed it to communications. And so, math was always my strong suit growing up, but I guess communications was sort of a weakness. But I chose communications not because it was a weakness, but because it was easy to get through as a major and like not have to read long books. You just kind of show up to these classes at that school and like make a presentation once in a while, and you got like A's from the professor. So I went through, the most of college with the communications degree, but I learned a lot. It taught me how to recognize, what's going on with media shenanigans with Tesla a little quicker, maybe because I learned about the media and how it works in school a little bit. So it helped me in some ways, and I just learned about communication in general, in ways that I didn't understand before that. So it's helped me because it was a weakness of mind, and I see that as a big problem today, actually, in business in general. Is many companies I've worked at, people just misinterpret what they say. They don't, like you have conference calls and people, think they understand what they're being told, or, you talk about something with a group of people on the phone and one person think it's like playing the game of telephone, when you're a kid, you tell one person something and by the end, everyone has a little bit of a different meaning of what was told originally. And you leave the conference call and everyone's kind of like on a little bit of a different page. They're not all on the same page necessarily. So you see that kind of miscommunication all the time in business, and it's kind of interesting.
Mm-hmm. Yeah. My major in college, the first 2 years was Street Fighter 2.
No way. I'd love Street Fighter 2. Dude, I gotta play you in that sometime. I was like
Yeah.
the king of Street Fighter 2.
Oh, really?
I
Yeah, I
I
went
was on
to I
for
went to like
years.
the state championships with Street
No
Fighter
way.
2.
I would have loved
Yeah.
that. I
Um,
used to go to these arcades and put a quarter in and play for like 2 hours with lines of people just playing.
exactly. Same. Yeah, exactly. Same here. One quarter the whole afternoon.
I
You
could,
know.
and I would just pick all different characters. I could beat people with any character.
Exactly. Any character. You know. You
You
just.
know what the best was? I remember like I was in high school and
Mhm.
we got it. It was on Super Nintendo, but it was 2 years before it came out on Super Nintendo. We got the Super Famicom adapter, which was like the Japanese Super
Uh,
Nintendo, and
yeah.
we ordered the Super Nintendo I mean Street Fighter 2 Japanese version. So we hit it on our Super Nintendo with the Super Famicom adapter in Japanese like 2 years before anyone else. So we were like figuring everything out at home all the time, even before anyone could play it at home on Super Nintendo. It was awesome.
Nice.
Yeah.
Nice.
But I have to play you sometime remotely, man. I think I could beat you.
Yeah, man. That was
It comes back to you. It's
Yeah.
like
Yeah.
riding a bike.
Yeah.
Play it. It just
Yeah.
feels like home.
I literally played like I was all day in the arcade. It was ridiculous. Luckily, I got my act together though. The last 2 years in college.
Yeah. I remember Street Fighter 2. That was amazing. Yeah.
um,
Yeah.
yeah, I think for me, college. I actually had a great college experience once I left my Street Fighter 2, days, because I had like a
What'd you
multi.
major in after that?
It's a multidisciplinary major that combined like political science, economics. We took courses from like history and other departments, but it was called political economy of industrial society. So it was a major at UC Berkeley, and it you actually had to learn a foreign language. I studied abroad actually for half of the year too, my junior year, but I was able to study. My major was studying how Asian countries were able to go from like like dirt, poor countries into mega economies, and what happened. What was the role of the government, the business, regulation, etc., trade, the whole picture, and you looked at it from all these different angles, and you just studied case studies of each country and all these stuff. And so it was like a fascinating major. Actually, I was actually blown away by the whole experience. But I mean, for me, when I look at university, I think the biggest thing is um, it's optional in the sense that what people need is they need to be able to create value in the workplace, and that value changes. And I think this is the key concept, in my opinion: the value that the workplace needs and the value that employees can give that's relevant, it changes radically, like year by year and decade by decade. Meaning,
Hmm.
like 10, 20, 30 years ago, like let's say when I was, graduating college, you wanted to have the whole Microsoft Word, suite, like, you
Yeah.
wanted to know Word, Excel, PowerPoint, etc. And like, if you knew
Yeah.
HTML, that was like a bonus, whatever. But it's like the way to create value, it radically changes very quickly, and the ability to be able to create high value and to adjust and change the value that you create over time, that's in my mind much more important than what university you went to or if you went to university, etc. And I think a large part of that is determined earlier on in a person's life. Like it's how you grow up, like what you're curious about, what you create on your own. You know, it's like this independence, that attitude of being able to do something that other people just can't do or won't do, and having that confidence to stick out and to contribute and to do something, you know. And I think a lot of that, I think, gets sabotaged earlier on in the school system, you know. They like strip that all out of you, so you're just like
Yeah.
this sterile, you know, docile, you know, person who's obedient, and
Yeah.
you don't know what to do now because you haven't been cultivated in this like independent kind of rigorous fighting attitude, you know, where you're developing and creating the best value in the world. You don't have that attitude. You're just like, okay, tell me what to do now. You know, like where do
Yeah.
I go? How do I get a job? Like what company should I apply for, etc. It's so
Yeah.
passive, right? And that's the danger, I think. And if I were to give advice to a younger person, let's say, you know, 18 or 19 years old, it's that somehow you've got to find a way to break out of that, break out of the passivity, the so-called obedience, docile attitude of having someone always needing to tell you what to do, you know, because that's not going to cut it. The world is changing so fast that you've got to find your own voice, your own skills, your own value, your own philosophy, your own approach, your own paradigm, and stick with it, you know, and actually, that's your career in a sense. That's, you know,
Yeah.
how you're going to be able to grow, I think, you know, earning power. But yeah.
No, that's definitely wise. Yeah, get a passion to find your own identity and figure out your own identity, what you want to be curious about, and go after that. Yeah.
Yeah. And it's interesting is because with investing too, like I took this little bit of unconventional route where I didn't think about, or I read a lot, but I didn't do much, or I didn't do much investing um, in my 20s. And it wasn't really until like close to my mid 30s that I started to invest. And that was actually crucial for me. And it sounds strange, but I spent like all my 20s traveling the world, seeing different cultures, different places, different peoples, seeing just context and learning and growing in a way that I think sometimes when people get into investing, I think also they get into investing. It's not necessarily the age that they get into investing, but it's how they get into investing. They think that that's the focus, the priority is to get gain, to get profit, to
Hmm.
grow something, their account, etc. But to me, I've always looked at that as a result. It's a trailing kind of result for me personally,
Hmm.
and I always look at it as there's more fundamental beliefs and habits and practices and skills at hand that allow you to grow, let's say, assets or resources rapidly. But to me, some of the most fundamental things is how you view the world, how you see things more accurately, how you see the future, the trends, and how you understand even people, you know, personality, relationships, how you gauge like reliability and trust from a person. Um, there's so many factors that are intangible in a sense. And I feel like because in a way I didn't focus on so-called making money or investing money for a period, and I focused on growing understanding of the world and life and all these other things, I feel like that has given me a foundation where I can apply all of that to analyzing and finding opportunities. And that's where yeah, I mean, it's a little bit atypical in a sense because,
Yeah, it is
yeah, my
atypical. Yeah.
focus, and still to this day, my focus really isn't on growing resources and assets as a top priority. To me, it's always kind of like this trailing result. It's something that follows something. It's hard to explain completely, but that's where I'm a little bit hesitant to tell people, oh yeah, you know, jump into investing and, you know, do all this stuff because like I think you can do that and it can be helpful, but my reservation is don't do it to the exclusion of
Hmm.
being able to learn about the world and building a bigger foundation of exposure and insight and understanding what's
Yeah.
going on. I think too many people, like
Yeah.
especially with COVID, we're just stuck in our houses, stuck in our,
Yeah.
on our phones, etc. And I don't know if we're
Yeah.
really like we're siphoned into such a narrow experience online. Like you think that you're getting exposed a lot, but really, are we really getting like a deep, like wide exposure?
No.
And
Yeah.
it's like we're in a way we're getting more narrow and more distant, it feels like, with our digital worlds that are completely different
Yeah.
from everyone else. And that's where it's like, yeah, man, it's that's a concern to me. But yeah.
That is a concern. I agree. Yeah. And I think you don't get, part of your experience is that also you're like a uniquely, competent person in general, at the high end of the spectrum there in terms of competency, and whatever you do, it seems like you're going to be pretty successful at. And not to say that, there can only be so many people like that, I don't know if I'm one. I'm probably not one. Maybe I am. I don't know. But you're definitely one of those people. And so the fact that you started at 35, you had a nice, you built a better foundation of understanding. So it gave you a better launch pad at 35 to be competent at investing with. So it was like a good combination for you. And maybe it's a good combination for some other people, but not everyone can be at the high end of the spectrum. There's an average. And I don't know, maybe the average people, I think, would be benefit from starting earlier, just to make the average mistakes early. And I don't
Yeah.
know, but
Yeah.
who knows for sure?
Yeah, I definitely agree. I think generally, because you have a limited time also to build resources, and especially with, I mean, this is an interesting topic too. It's like the concept of retirement, like it's weighing on my mind more, because I feel like it's becoming an increasingly difficult kind of milestone to achieve for people, to retire with ample resources. Like my first, or kind of my big exposure, was with my own parents. I saw them about, this was over a decade ago, when they entered retirement, maybe about 10, 15 years ago. Like they thought that they had their retirement set, that it was enough for them
Yeah.
to live on. But when I looked at it, I'm like, this is cutting it
I've seen
short.
that. Yeah.
It's like, I
Yeah.
don't think you understand what's going on. Like you guys can live actually quite a long time, and your needs can
Yeah.
grow over time too. And so I'm like, man,
Yeah.
you've got a problem here. And they didn't see it, but I had to
Yeah.
spend like a lot of time
I've seen
wrestling,
that.
trying to help
Yeah.
them, and like really go through some major rehaul of their entire retirement plan to help them change their approach. But yeah, I mean,
Yeah.
with that, with kind of, you know, um, things in the future uncertain, I do think that definitely there's a role to start early, and to do it in a way where, yeah, um, there is a sense of taking ownership of your finances and your future, and
Yeah.
and
And maybe just doing, not focusing everything on, but just doing it as like a hobby, and
yeah,
in parallel with whatever your life mission is, to
exactly.
explore the world and do other things.
Yeah, I think
Yeah.
it could be done like simultaneously. Like that's probably, yeah, the wisest thing.
Yeah.
um,
Yeah.
anyways, always good chatting, Emmett.
Yeah, definitely, Dave. Yeah, great
Yeah.
chatting, and looking forward to seeing what happens between now and January 15th. I don't know. We'll see.
Yeah, definitely.
Yeah.
All right, man. Have a good one,
All
and
right.
we'll talk soon. All right.
All right.
Yeah,
Talk to you
bye.
later.